All right, diving in today, and we're going deep on something that's, well, it's fundamental. It's technical momentum, that force behind price movements, and the key to figuring out, where those prices might be headed next.
You got it. And honestly, for anyone prepping for a technical analysis exam, really grasping technical momentum, that's like unlocking a whole world of indicators. It goes way beyond just memorizing formulas. It's about understanding the why, the how behind the numbers.
So that's exactly what we're aiming for in this deep dive. We're going to break down technical momentum, how it's measured, what those measurements tell us, and how all of that connects to all those different technical indicators we use. Think of it like your own personal exam prep session, using some top-notch resources on momentum and technical analysis.
And whether you're just getting started with this stuff or looking for that extra edge before the big test, we're going to unpack some complex ideas and hopefully make them click. Those aha moments that make it all come together.
Okay, so let's start at the very beginning. Technical momentum. At first glance, you might think it's just about how much the price has changed over a certain period and in which direction.
Yeah, that's a good starting point, a good intuition. But to really nail it for your exam and for actually using it out in the real world, we got to be a little more specific. Technical momentum is really better understood as this concept of the distance the price travels over time, which is average velocity, and the direction of that travel considered through time, and that gives us average acceleration.
Average velocity through time. Okay, so like the rate of change, the ROC, which measures that percentage change in price between 2 points over a specific time. That seems like it's capturing that average velocity we're talking about.
Absolutely. You got it. The ROC, it gives us that snapshot of average velocity. And here's where it gets really cool. If you calculate a series of these ROC values, one after another over time, you end up creating an indicator that moves and changes itself. And that movement, that's representing the average acceleration, so how that rate of price change is itself changing over time. Technical momentum, it's not just about speed, but about the change in that speed as well.
And this is where it gets super fascinating for me because it sounds like we're delving into some real physics concepts here,
Yeah.
right? You mentioned average speed, average velocity, and acceleration. I think a quick example would really help solidify these concepts, especially for anyone prepping for that exam.
I think so too. A visual really helps. Imagine someone walking, right? They walk, let's say, 10 feet east, then 5 feet north, then 10 feet west, and finally 5 feet south. In total, they've walked 30 feet. Now, if they did all that in, say, 10 minutes, their average speed would be that 30 feet, that total distance, divided by the time, so 30 feet over 10 minutes. But here's the thing. Average velocity is a different beast. It's about displacement, how much their position changed from start to finish, divided by time. In our walking example, they end up right back where they started, right?
All
So
right.
their displacement is zero, meaning their average velocity is zero, even though they walk 30 feet. Average speed, it's just a number, a scalar quantity, whereas velocity has both a number and a direction, so it's a vector.
Okay, so it's not just about how much ground you cover, but where you end up relative to where you started. Makes sense. But how does acceleration fit into this, especially when we're talking about market momentum? How do we connect these physics ideas to help with the exam?
Yeah, so often we use acceleration just to mean speeding up, right? But in physics, and this is crucial for understanding technical momentum, average acceleration, it's not just about how fast something is going. It's about the change in velocity over time. So in the market, it tells us if that rate and direction of price change are becoming more intense or less intense. The formula, average acceleration equals the change in velocity over time, aberration, or you can say final velocity, VF, minus initial velocity, V0, all divided by time.
So when we think about the market and keeping in mind that exam focus, technical momentum is really all about that average acceleration, how the rate and direction of price change are themselves changing over time. It's not simply that prices are going up, but how they're going up. Are they speeding up, slowing down, or staying steady?
Absolutely. It's that average velocity, how much the price is changing, over what time, and in which direction seen through time. And what's really fascinating for actually using these indicators is how those signs of velocity and acceleration, how they play together, and what that tells us about price movement and the overall technical momentum condition. That's key to seeing potential shifts in trend.
So break it down for us. What happens when those signs match up, when they don't, and what should we be looking for on our charts?
Okay, so let's say you have positive velocity, meaning price is going up, and positive acceleration, meaning the distance between those price points on your chart is increasing. That's positive acceleration in the context of technical momentum. prices gaining upward steam. If you have positive velocity but zero acceleration, meaning the space between the points is constant, then that steady acceleration, price is going up at a steady pace. But, and this is important, if you have positive velocity but negative acceleration, that space between your price points is getting smaller, then that's negative acceleration. Price is still moving up, but that upward momentum is slowing down. That's a big one, to recognize potential weakness in a trend, even when prices are still climbing.
It's like a rocket slowing down before it changes direction, right? What about when the price is going down? What does that look like?
It's like a mirror image of the upside. So negative velocity, meaning price is going down, and negative acceleration, those price points getting closer together, is negative acceleration or technical momentum, just in the opposite direction. Negative velocity, but with zero acceleration. That's steady acceleration downwards.
Yeah.
And negative velocity, but with positive acceleration, meaning the distance between those downward price points is increasing, well, that's positive acceleration in a downtrend, meaning the downward momentum is picking up steam. And then, of course, zero velocity, zero acceleration means price is just flatlining, no movement.
Got it. And we can see these conditions playing out on actual charts, right? The source material mentions figure 9.1.1, which shows the S&P 500 with ROC indicators. I think being able to visualize this stuff is really helpful for the exam, see how the theory actually works in the market.
Oh, definitely. Those arrows on the ROC charts, they do a great job of illustrating all 6 of those technical momentum conditions we just talked about. You can see examples of positive acceleration, that upward movement gaining steam, steady acceleration where it's constant, and the negative acceleration where it starts to lose that upward thrust, even while the price is still going up. And then, of course, you see the same thing happening in reverse when prices are falling. It's really helpful to pay close attention to how that ROC indicator changes its direction in each of those scenarios.
Okay, I feel like we have a much clearer picture now of what technical momentum is in terms of those physics concepts of velocity and acceleration. Now let's talk about how we actually interpret it using different indicators and what are the key takeaways for, acing that exam.
So George Lane, the guy who created stochastics, he had a great way of putting it. He said that momentum indicators, like stochastics, lead price because they show the speed or momentum of price. And as we know now, that's the changing distance between those observations over time, that acceleration we were just talking about. That's why momentum is considered a leading indicator. It can give us a heads up about potential changes in the price trend.
And he used that rocket analogy, right?
Yeah.
Like a rocket blasting off with a ton of thrust, which would be a high ROC, then traveling steadily, ROC kind of fluctuating but staying positive, and then finally slowing down, ROC falling and showing those divergences before maybe changing direction altogether. I think for the exam, that analogy can be a great way to remember the different phases of a trend and how momentum indicators reflect those.
It's a classic for a reason. And that slowing down where those ROC observations start getting closer even as price is making those higher highs, that's really the foundation for understanding negative divergences. And of course, the opposite is true for downtrends. Understanding momentum, it helps us see when trends are ticking off, how strong they are, and when they might be starting to fizzle out. Now, each indicator has its own way of being calculated, but the basic principles of interpretation, that idea of changing velocity, those stay pretty consistent.
Makes sense. Now, there's also a lot of talk about indicators being overbought or oversold. In the context of momentum, what do those terms actually mean, and how should we be interpreting them, especially for exam questions?
So, overbought and oversold, they're conditions, not actual buy or sell signals. They're telling us that an indicator has hit an extreme level, suggesting that the current trend, well, it might be about to change or at least pause. But, and this is super important for the exam, the market can stay overbought or oversold for a while. As they say, the market can stay irrational longer than you can stay solvent. So these conditions are more like alerts to pay attention, not necessarily to jump ship.
Right. It's like a reminder to not make hasty decisions just because an indicator is flashing overbought or oversold.
Yeah.
So how do we interpret these conditions in different market situations? Are there any exam relevant nuances there?
Definitely. So in uptrends, you'll often see momentum indicators stay overbought for a good stretch, and they rarely dip into oversold territory. So in that context, an overbought reading might actually be a sign that the uptrend is strong, and some momentum traders might even see it as a chance to buy more. Conversely, an oversold reading during an uptrend might be a good entry point for someone looking to buy, thinking the upward trend will keep going. The main point for the exam, the context of the overall trend, is key when interpreting those levels.
Okay, so overbought in an uptrend isn't necessarily a sell signal. What about in downtrends? How does that change things?
In downtrends, it's the flip side. Indicators tend to hang out in oversold conditions for longer and rarely become overbought. So in this case, oversold readings might actually be attractive to momentum traders looking to short the market, expecting it to go down further, while an overbought reading could be seen as a good time to open a short position, betting on that downtrend to keep going.
And in those range-bound markets, where it's just bouncing around, it's a bit simpler, right? Overbought could mean a move down is coming, and oversold, a move up. That's a key difference to keep in mind for the exam compared to those trending markets.
Yeah, generally speaking, that's the idea. But, for the exam, the real takeaway is how you interpret and what you do based on those overbought or oversold conditions depends on your goals as a trader, how long you're planning to hold a position, and really importantly, what the overall market trend is. A short-term trader will react very differently to an overbought signal compared to a long-term investor.
That makes sense. Let's switch gears now and talk about divergences. These seem super important for understanding momentum, and they come up a lot on those technical analysis exams.
Definitely a big one. The ideal scenario, what we call confirmation, is when the price is making a new high in an uptrend or a new low in a downtrend, and the momentum indicator is making a new high or low right alongside it. That gives us more confidence that the trend's going to keep going. So for the exam, remember, confirmation reinforces the current trend.
But what about when that doesn't happen? What about when they don't match up? That's when we get divergence, right? That non-confirmation thing.
Exactly. Divergence, it's when the price makes a new high or low, but the momentum indicator doesn't follow suit, doesn't make a matching new high or low. That can be a warning sign that the current trend might be losing steam, that acceleration we were talking about, and maybe it's going to reverse, or at least take a breather. Recognizing these divergences is a vital skill for any technical analyst, and you'll definitely see questions about them on the exam.
And there are two main types of basic divergence, right? Negative and positive. Let's start with negative divergence. That happens in uptrends, right?
Yeah. In a negative divergence during an uptrend, the price makes a high, then goes on to make an even higher high. But here's the divergence. The momentum indicator makes a high that matches up with that first price high, but then makes a lower high when the price hits its second, higher high. It's not confirming that new high price, which could mean upward momentum is fading. Remember Lane's rocket analogy. It's like the rocket slowing down. And figure 9.1.2, the one with the SPDR industrial sector ETF XLI, it shows this really well. Price kept making higher highs, but the ROC topped out earlier, signaling that loss of upward momentum, and eventually the price stalled out and reversed. For the exam, remember, negative divergence in an uptrend, that's a bearish signal.
Got it. And then positive divergence, that's the opposite scenario, right? It happens during downtrends.
Exactly. With positive divergence in a downtrend, price makes a low and then goes on to make a lower low. But the momentum indicator, it makes a low matching the first price low and then makes a higher low when the price hits its second lower low. It's not confirming that new low price, which could mean the downward momentum is weakening and a potential reversal to the upside might be on the horizon. Figure 9.1.3 on XLI, that also illustrates this. Price making those lower lows, but the ROC makes a higher low, and that's what happens before a price rise. For the exam, positive divergence in a downtrend, that's a bullish signal.
Now, the source material also talks about these divergence traps, which sound a bit like false signals, right? How do these work and how can we spot them both in real trading and on the exam? Got to avoid those traps.
Yeah, they can be tricky. Martin Pring calls them divergence traps. George Lane sometimes just calls them divergences. So a negative divergence trap, it happens when you've got that negative divergence setup, momentum making those lower highs while price keeps making higher highs. But then right before the price actually starts to fall, momentum does this unexpected thing and makes one final higher high. It breaks that pattern of lower highs and it looks like, oh, the negative divergence was a false alarm.
So it's like a fake out. It seems like the divergence was wrong.
Exactly. But then usually pretty soon after that trap, the price does start to drop. Figure 9.1.4, the one with Campbell's CPB. That shows this really well. You see that negative divergence, then that final higher high in momentum right before the price breaks down. Positive divergence traps, they're the same idea, but in reverse, happening during a downtrend. Momentum is making those higher lows while price is making lower lows. Then bam, momentum makes one last lower low just before the price actually starts to climb, breaking that pattern of higher lows. Figure 9.1.5 on Goldman Sachs GS, that gives you a visual, although it does mention it's not a perfect example. That's a good reminder that the market doesn't always play by the rules perfectly. Understanding these traps is crucial for avoiding those knee-jerk reactions based only on divergences.
Yeah, it's like momentum is making one last push in the direction of the main trend, then finally giving in. Definitely a reminder that we need to see the price confirm things before jumping in.
Absolutely. And it's also important to understand for the exam, divergences, whether they're regular or traps, they don't always lead to those price changes we expect. The market's not perfectly predictable.
Right, like in figure 9.1.6 with Merck, MRK, there was no divergence before it bottomed out, and then it rallied after a positive divergence. And in figure 9.1.7 with IBM, there were a bunch of positive divergences that didn't immediately lead to a price increase. So these examples show that divergences aren't foolproof.
Exactly. Sometimes divergences, well, they just don't mean much. Price action is the ultimate decider. That IBM chart also shows that concept of polarity, where a previous resistance level becomes support after momentum shifts, even if there wasn't a perfect divergence at first. For the exam, price action should always be your final confirmation.
Okay, and the source material mentions some other types of divergences, not just the basic negative and positive ones, things like positive and negative reversals that Cardwell and Brown use with RSI, and Lane's bull and bear setups with stochastics. Are these important for exam prep too?
Yeah, knowing these extra details can definitely help you stand out. So, Cardwell and Brown, they saw bearish divergences as features of uptrends and bullish divergences as features of downtrends, which suggests the trend is more likely to continue rather than reverse. Lane's bull and bear setups with stochastics, on the other hand, were specifically warning signs for potential tops or bottoms. Figure 9.1.8, the one with IBM, RSI, and a moving average, gives you a good look at all those different divergences and reversals, and it emphasizes that they're really just conditions. The final outcome. That depends on price confirming things. Figures 9.1.9 and 9.1.0, those show you slow stochastics with examples of traditional divergences, bull and bear setups, and also cases where divergences don't lead to any big price move. Familiarizing yourself with these concepts will be a big help for the exam.
So if divergences are warnings, not guarantees, how can we tell how important they are, both for actually trading and for answering those exam questions about how reliable they are?
That's the million-dollar question. Remember that car analogy. If the car is moving forward, positive velocity, but you ease off the gas, that's negative acceleration, so your momentum indicator is dropping. Does that automatically mean the car is going to reverse? Nope. The driver might just step on the gas again. So we need to look for clues that make that divergence warning more serious.
Okay, what are some of those clues, those things that increase the significance of a divergence?
One big one is the number of divergences happening in a row. If you see multiple divergences right before a price peak or trough, like those 3 negative divergences in figure 9.1.2, compared to just the one in figure 9.1.3, that makes the warning a lot stronger. Another thing is how long the divergence lasts. A divergence that goes on for months, like in figure 9.1.0, that's usually a lot more meaningful than one that only lasts for a few weeks, like in figure 9.1.9. For the exam, remember, more divergences, longer time period. That usually means a bigger shift in momentum is happening.
Yeah, that makes sense. A longer divergence suggests that underlying shift in the forces driving the market, that it's more significant, more persistent.
Exactly. Also, think about the length of the trend you're looking at. If you're trying to analyze a long-term trend, make sure you're comparing price and momentum trends over a similar time frame. Figure 9.1.11 shows a good example of this with different trend lengths. And finally, where that momentum indicator is relative to its equilibrium, its zero line. When the final divergence occurs, especially with the rate of change, that can be a big clue. If the price is making a new high or low, but the indicator is close to zero, that can be a stronger warning that a reversal might be coming. So pay attention to all these factors when you're studying those charts for the exam.
Awesome. I think we've covered a lot about what momentum is and how we interpret those overbought, oversold conditions and divergences. So now let's shift gears and talk about actual signals. How can we use momentum indicators to maybe make some buy or sell decisions, keeping in mind that exam focus on actually using these concepts?
Sounds good. Just like price, momentum moves in trends. And just like we use things like trend lines and moving averages to study price trends, we can use those same techniques on momentum charts. The idea here is that reversals in momentum trends might come before reversals in price trends, as long as the momentum trend doesn't just keep going in the same direction. For the exam, remember, analyzing momentum trends can give you some early hints about what the price might do.
But you said might. A momentum reversal doesn't necessarily equal a price reversal, right? That's important for avoiding mistakes, both in trading and on the exam.
You got it. Remember that car analogy? Positive velocity and negative acceleration. It just means the car is still going forward, even though it's slowing down. Actual buy and sell signals, those that tell you the price trend is changing, those only come from price itself, not just momentum. Momentum can give us strong clues and warnings, but price has the final word. That's a fundamental principle for technical analysis.
All right, let's talk about trend lines on momentum charts.
hmm
How do those work, and what should we be looking for, especially for the exam?
It's the same basic idea as drawing trend lines on price charts. Connect the lows during an uptrend in momentum and the highs during a downtrend in momentum. And when momentum breaks through one of those trend lines, it's usually a sign that the momentum trend has changed. Now, it doesn't automatically mean the price trend is changing, but it's a good early warning sign to pay attention to. Figure 9.2.1, the one with the S&P 500 and the ROC, it shows how momentum often breaks its trend line before price does. That could be an early hint that the price trend is about to change, or at least pause. So for the exam, momentum trend line breaks can happen before price trend line breaks.
And the things that make those momentum trend lines more important, like length, number of touches, slope, are those the same things we look at for price trend lines? That consistency across different types of charts is helpful to remember for the exam.
Absolutely, same principles. Longer trend lines, more touches, and gentler slopes, those are usually seen as more important. And just like price trend lines, even after a momentum trend line is broken, it can still act as a sort of, well, a pivot point. Previous support might become resistance, and vice versa.
What about moving averages? Can we use those on momentum data to maybe generate some signals? And how does all of this connect to what we might be asked on an exam?
Definitely. Moving averages can actually be more objective than trend lines, which can be a bit more subjective. One common way to use them is to look for crossovers, where the momentum indicator crosses above or below its moving average. Ideally, this would happen right before the price itself crosses its own moving average. However, momentum data can be really jumpy, leading to lots of false signals, what we call whipsaws. Increasing the look-back period, either for the momentum series or the moving average, can help smooth things out a bit. So for the exam, understand that those momentum moving average crossovers can give you signals, but be careful about those false signals. They happen.
And the distance of that crossover from the equilibrium level, that also plays a role in how reliable the signal is, right? That seems like a key point for evaluating the strength of a potential trade based on momentum.
For sure. A momentum moving average crossover that happens close to the equilibrium level is more likely to actually signal a trend reversal in the price. But if it happens far away from equilibrium, well, it might just mean that price is going to consolidate for a bit, or maybe even make a counter trend move. Figure 9.2.2, the one with Peloton PTON, shows a good example of using moving averages on both price and momentum, the ROC in this case, to generate potential signals and warnings. Look at how those crossovers and the slope of the momentum's moving average relative to zero can give you some really useful insights. And for the exam, when you're analyzing those crossovers, keep in mind that equilibrium level.
Right. Earlier, we talked about those overbought and oversold conditions. So how do crossovers of those levels act as potential signals, and what should we consider for the exam?
Remember, overbought and oversold, those are conditions, not signals themselves. But we can get signals from them when an indicator crosses back below an overbought threshold or back above an oversold threshold, essentially heading back toward that middle ground, the equilibrium level. Those crossovers can tell us that the extreme condition is easing up and a move in the opposite direction might be getting started.
So these signals, we might interpret them differently depending on what the market's doing overall, right?
Yeah.
It seems important for using these concepts correctly.
Exactly. In those choppy, range-bound markets, falling below overbought from above, that could be a sell signal. Rising above oversold from below, a buy signal. In uptrends, those oversold conditions, those are usually seen as buying opportunities, while overbought readings are generally just signs of strength, not necessarily a reason to sell. And in downtrends, those overbought conditions are often seen as chances to sell, while oversold readings, they might just mean that the weakness is continuing. Figure 9.2.3, the one with Uber, UBER, with the RSI and its moving average, it illustrates these overbought, oversold crossover signals, and it shows how they can be misleading sometimes. It also shows how downtrends can stay oversold for quite a while. So for the exam, always keep the bigger trend in mind when you're looking at those overbought, oversold crossovers.
We also came across mega overbought and mega oversold. Sounds like a more extreme version of those conditions, maybe with different implications. Something we should keep in mind for the exam.
Yeah, that's a concept Martin Pring came up with. A mega overbought condition. It's this super strong initial surge in a bull market, happening right after the final low, where that momentum oscillator hits multi-year or even record highs. Kring suggests this often points to a brand new bull market, and in this specific case, opening a long position from an overbought condition that might actually make sense for long-term investors, especially after a pullback or consolidation. And the thing is that previous low, it usually doesn't get revisited for years. Mega oversold? Well, that's just the opposite, happening in a bear market. Figure 9.2.4 with JP Morgan Chase JPM after the 2009 low, that shows you a mega overbought condition leading into this long trading range before a big uptrend kicks in. While it might not be covered in basic technical analysis exams, understanding this concept shows you have a deeper understanding of momentum.
Okay, let's move on to specific momentum indicators. What about that price oscillator or trend deviation indicator? How does that work? And what are the important things to remember about it for the exam?
That's another way to measure momentum, and it's all about how much the current price has strayed from a moving average, basically the smoothed out trend. Often, it's calculated as the difference between a short-term moving average and a longer-term one, and then that's expressed as a percentage of the longer-term average. The source material gives a bit of a simplified formula. The main idea is that it shows you how far prices stretched away from its average. Figure 9.2.5, the one with Boeing, BA, that shows a price oscillator along with the ROC and RSI, and you can see how their patterns are pretty similar. The key difference between that 150 price oscillator shown and the 50-period ROC is that the price oscillator measures the distance between the current price and the 50-period moving average, while the ROC measures the distance from the current price to the price 50 periods ago. Just like other momentum indicators, you can use it to spot overbought and oversold levels, divergences, and track how momentum's trend is doing compared to the price. So for the exam, recognize that it's another tool for visualizing momentum, specifically in relation to a moving average.
And we've talked a bit about the rate of change, the RSC, already. Any other ways to use that for generating signals or backing up trends? Anything to really focus on for the exam?
So as we talked about, ROC, it measures the percentage change in price over a certain time. Beyond just spotting velocity and acceleration, overbought, oversold levels, and those basic momentum trends, you can actually use multiple ROCs, each with a different look-back period, to get a feel for momentum across different time frames. And you can even look for divergences between different ROC indicators. For example, in an uptrend, let's say the price makes a higher high, and a longer-term ROC also makes a higher high, but a shorter-term ROC makes a lower high. That can be a big red flag, a negative divergence signal, suggesting that short-term momentum is weakening even if the longer-term trend is still in play. The same thing applies in reverse for downtrends. Figure 9.2.6, the one with Danaher, DHR, it shows an example of that negative divergence between a 10-period and a 21-period ROC as the price is making higher highs. And then this gets confirmed when the price drops below its moving average. Keep in mind, those divergences between indicators, they're often most effective when the shorter-term ROC is near its equilibrium level, near zero. Using multiple ROCs to spot those subtle shifts in momentum, that's a valuable concept for the exam.
Right. And then there's Martin Pring's No Sure Thing, the KST indicator. That also uses the ROC, but in a more combined way, right? What are the key takeaways for the exam when it comes to the KST?
Exactly. The KST, it combines 4 different ROCs, each looking back over a different period. Then these ROCs, they get smoothed out using simple moving averages, weighted, and then added together. And it has its own SMA signal line too. The longer the look-back period of the ROC, the more weight it gets in the KST calculation. Figure 9.2.7, showing the NASDAQ 100, the NDX, it shows short, medium, and long-term KSTs. Look at how all 3 of them crossing above or below their signal lines can confirm accelerating momentum across those different time frames, and how that long-term KST can be really helpful in figuring out the main trend, even when those shorter-term KSTs show divergences. For the exam, remember, the KST, it's like a momentum all-star team, designed to pick out those major trend changes by looking at multiple time frames at once.
Okay, let's move on to the moving average divergence, the MACD. So the popular one, and I'm sure understanding its signals will be on the exam.
Oh yeah, for sure. So the MACD, it's basically the difference between 2 exponential moving averages, EMAs, usually a 12-period EMA and a 26-period EMA. Gerald Appel, the guy who came up with it, he said the important thing is to look at whether the MACD line is above or below 0 and whether it's moving up or down. Above 0 and rising, that's the best situation for uptrends. Below 0 and falling, the worst for downtrends. When it hits those historical extremes, that can also point to overbought or oversold conditions. The zero line itself, that's the equilibrium point where those two EMAs are equal. For the exam, make sure you know those basic interpretations of the MACD die line in relation to zero.
And the basic buy and sell signals, those come from crossovers between the MACD line and its signal line, which is usually a 9-period EMA of the MACD itself, right? Those crossover signals are fundamental for the exam.
Yep, that's it. A basic buy signal happens when the MACD line crosses above its signal line from below, and ideally when the MACD is below zero. That suggests upward momentum is building after a potential downtrend. A sell signal is when the MACD line crosses below its signal line from above, ideally when the MACD is above zero. That tells us downward momentum is taking over after a potential uptrend. Appel said these signals are more reliable when they happen after a divergence and when they agree with the direction the price's moving average is going. He also recommended using stop signals as a way to manage risk. New lows in the MACD for long positions and new highs for short positions. Figures 9.2.8a through 9.2.8, those are the ones with McDonald's, FCD. They show those programmed buy and sell signals based on Appel's rules. They show how important the slope of the moving average and where the MACD is relative to zero are in confirming those signals. Make sure you're familiar with these crossover rules and the filters he suggests. They're important for the exam.
The material also talks about Appel's 2-MACD system. How does that work, and do we need to get into the nitty-gritty of that for a general technical analysis exam?
It's basically Appel using two MACDs with different settings, a faster one to trigger buy signals and a slower one for sell signals. His idea was that markets usually drop faster than they rise. He suggested settings of 13, 26, and 9 for the fast MACD, your buy trigger, and 19, 39, and 9 for the slow MACD, your sell trigger. The buy signal is when the fast MACD crosses above its signal line while it's below zero, and you hold that position until the slow MACD goes above zero and then drops below its signal line. The sell signal is when the slow MACD crosses below its signal line, while